Welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me back at MarketSite in Times Square, we have Richard Johnson. He's the Principal of Market Structure and Technologies over at Greenwich Associates, and we're going to understand how to make markets better for investors of all types. Richard, it's great to have you back with me.
Good to see you, Jill.
As always, let's talk about this Nasdaq Total Markets. It's our blueprint for a better investing environment for tomorrow.
Yeah, so they came out with this white paper a couple of weeks ago talking about how can we make market structure better. And market structure is what I do. It's my full-time job, so it's a subject close to my heart. And it's important because we want markets to be as efficient as possible for everyone out there. If you have efficient access to capital, that helps drive the economy overall. So it's a very important piece of work.
So before we get into the 5 key metrics of this blueprint, what are some of the challenges that are out there right now that investors are facing?
Yes, well, you have one of the big challenges, I think, is that you have a market that's kind of one size fits all, where you have the same market structure, the same number of exchanges for every stock out there. Now that's fine if you're Microsoft or Apple or one of the most liquid stocks. It works very well for you. But if you're an issuer and your stock is much smaller, maybe it's only a few $100 million in market cap and it trades a lot less per day, then the existing market structure can be a bit complicated. And we often hear from our clients at Greenwich Associates that they have difficulty trading these types of names. So, some of the ideas in the paper was, can we figure out ways to make it easier for some of the less liquid securities to trade and help investors get better access to these shares?
All right, and I would imagine another key point of this is reform, regulation for sure.
Yep. It's a very regulated market. Everything has to be done, with the regulators say so. Regulators say so, yeah.
Mm-hmm. All right, and what are some of the other key foundings that struck a nerve with you?
So I guess one of the big ones was something called unlisted trading privileges, which is kind of an arcane term. What that means is, so Nasdaq was suggesting that you suspend it for less liquid securities. This is in fact something that Brett Redfern, who is the Director of Trading and Markets at the SEC, has also suggested. So it's certainly got some regulatory backing perhaps up there. What it means is, so Nasdaq's one exchange. In fact, when Nasdaq operates 4 different exchanges, there are another 9 out there. And the idea is, well, maybe it doesn't make, like I said, for Microsoft and Apple, it's great that there's all this competition, all these exchanges competing and trying to find the best price. But if the stock only trades a few 100,000 shares a day, maybe only a few times a day, doesn't make sense to have all this liquidity fragmented across the 13 exchanges. And then also beyond that, we have dark pools and other types of venues as well. So I think it's an idea worth exploring. So what it means is unlisted trading privileges, meaning that it can only trade on the listing exchange.
Right. And they also talk about providing data choice as well within the paper.
Yeah, so this is a little bit of an arcane one, but what happens is when people subscribe to market data, they can be classified as a professional or a non-professional subscriber. And so I think what Nasdaq was, and this, for some instances, can increase market data costs for some firms out there who, just because they're a bank, they have to pay the higher rates. So they're suggesting some more intelligent definitions of professional and non-professional.
So the real key takeaway here is one size does not fit all, and that it should be more customized to each issuer's needs and so forth.
Yes, I think that's an important thing. There's something else in there was suspension of the order protection rule, which is another important. It has been an important part of market structure, but perhaps it's time for a rethink. It was originally put in place over 10 years ago as part of Reg NMS. Maybe the time has come to reevaluate that. I think that's interesting.
Well, and it makes sense too because markets evolve so quick these days, particularly with technology, and this blueprint sounds like it's trying to catch up to that and make the markets a more fair and orderly place for issuers and investors of all types. Yes,
and I think the idea that what we have is a one size fits all is and maybe we should address that. I mean, there used to be 8,000 listed securities in the country, in the US. Now it's below 4,000. There's other reasons for that. We've had a lot more private equity right now, for example. But let's take a look at that. We want companies to have access to capital. We want to kind of, more jobs happen in smaller companies. That's the driver for job growth in this country. So we want smaller companies to have access to capital. We want to have access to public markets because we want everyone to invest in them, not just private equity investors or so-called accredited investors. So let's figure out a way where we can make it not so much a one-size-fits-all.
All right, Richard, thank you so much for joining us at MarketSite. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.